Forecasting is always related to business valuation. Um, so we always make forecasting, right? Forecasting of revenues, net income, free cash flows, and all other accounting items. So today we are going to talk about forecasting. And this is something that always becomes the main activity, also the main attention of every business. Okay, let's go straight into our discussion. So I'll present. Okay, so uh, every time we discuss forecasting, right, or valuation, the story always starts with revenues, right? And like in uh, almost all companies, and if we are not exaggerating, right? So we could say if all companies always expect or always project higher revenues from time to time. And I went in my earlier years of as a consultant, when I had some clients where actually I found, or using my econometric techniques or other things, I found that they had like decreasing trend, or I made some projections such as those. But all of the clients always want increasing projections of revenues, right? Because now, firstly, that's I think the nature of being an entrepreneur, right? You want to achieve more, you want to attain a higher level of achievement, right? Financially and also non-financially. And also, secondly, I think that would encourage your organization members, right? Your employees, your executive to achieve higher. And that's most of the time too, right? When you make higher revenue projections, and one way or the other you achieve your targets, and then you keep increasing your targets from time to time, right? That's quite natural. Okay, so what is the main consequence here? If you make an increasing projection of revenues, then the increasing revenues would require the increasing amount of assets. Okay, of course you could argue that you still have like idle capacity, or you have yet to use all of your assets capacity, right? But I think that would be that would happen in like time of exception such as this. You could say because of the healthcare crisis that the world is having right now, uh, you have like a lot of idle capacity in your factories, in your buildings. Then when the good time comes back, right? When the period of crisis is over, then you're saying that I have uh, that a lot of like capacity for my assets, right? So I don't need to add more assets. I don't need to add more buildings and everything. So this could be imagined easily, right? If we use the airlines business that I always like to use, right? So if you want to serve more routes, you want to serve more passengers, more services, more packages, then naturally you need more aircraft, right? You have to lease more, uh, or you have to build more representative offices. You have to build uh, more, yeah, some stores and everything, right, to support the increasing revenues that you want to achieve, right? Again, this is, I think, the natural, no, business mechanism where we have to go through. If you want higher revenues, then most likely you have to increase the capacity and also the quantity of your assets. Again, arguably, you can say in certain periods of time, you might not need to increase assets, although you try to achieve higher level of revenues. But in normal time, again, you can use another example. maybe you're a consulting firm, right? You want to serve more customers, right? You want to enlarge the uh, customer base. Then you have to build more again offices in many other areas, many other cities, or even many other countries, right? So to achieve your target revenues. Okay, so increasing assets, right? Increasing assets are required to support the increasing revenues that you target. So now the question is, what type of assets, right? What type of assets? Which assets that we have to increase? You can call them like spontaneous assets or, or simultaneous assets, or automatic assets, or whatever name you want to call them. But again, this is the type of assets that will simultaneously or spontaneously increase because of the increasing revenue projections that you make. Right? So now we come to the next question, right? How to finance the increase in assets that you plan or that is necessary to support your revenues, your increasing revenues. Then we can go back to the what's that natural accounting logic, right? Standard accounting logic. We have assets here, of liabilities and equity. So some of your assets will have to increase, right? Because of the increasing revenue projections. Some of the assets will have to increase spontaneously. Now the question is, do we have specific liabilities or similar type of liabilities that will simultaneously or spontaneously increase because of the increasing assets that is required to support the increasing revenues, right? So first question is, do we have such liabilities, right? Spontaneous liabilities that will increase uh, again to finance or to support the increase in assets, right? That is necessary to support the increasing revenues that we project, right? Or we estimate. Or another possibility would be the natural increase in your equity. Where is it from? Of course, the natural increase in your equity would be from the retained earnings, from your retained earnings, right? Addition to your retained earnings, that would be the internal funding that could help support the increase in assets necessary to support the increase in revenues that you expect or you want. Okay, so it's quite straightforward. Let me repeat again before we see the formula and also an example. So we have made revenues projection, and most likely or almost all the time we are making uh, an increasing projection for our revenues. So the increase in revenues will require an increase in assets, right? This is natural. This again hard to imagine if you want to keep increasing your revenues without the willingness to invest in more assets. That cannot happen, right? Or that could happen with really low quality of service, right? So you try to push harder with existing assets to support the amount of revenues that you want, and you try to increase the revenues more and more. It means that you might exploit the current equipment, and of course they will be broken sooner, right? They'll be burned down and something like that. But again, naturally, you need an increase in assets to support the increasing revenues. So what type of assets? The spontaneous types, right? That will spontaneously or simultaneously increase with the increase in revenue projections. So how to finance the increase in assets? Again, the first possibility, the spontaneous liabilities, right? Spontaneous liabilities that will, again, also spontaneously increase with the increase of your assets, right? And then another possibility would be the natural equity funding, right? Addition to your retained earnings, right? Retained earnings. Okay, so now we'll see the formal equation. So what is the meaning of this again? So we have an increasing revenues. We need supportive assets. Like we need an increase in assets to support the increasing revenues, and then we get help from these two internal funding, right? The spontaneous liabilities that will increase, and also the internal increase in equity, right? Natural increase in equity from retained earnings. If these two are not enough, if these two are not sufficient, then we'll need what we call EFN. EFN, right? External funds needed, right? Or external financing needed. So we'll need EFN if the internal funding, such as the spontaneous liabilities increase, and also the increase in the natural equity, which is the retained earnings, are not sufficient to support or to finance the increase in assets as a consequence of the increasing revenue projections. Then we'll need EFN, right? External funds needed. Okay, if you see the formula now, so EFN, right? So get the first part. Now imagine you have spontaneous assets, right, in the current year. So we call them spontaneous assets because uh, we define them as assets that will spontaneously go up because of increasing revenues, right? If these spontaneous assets are divided by the current revenues, so we could imagine this is the ratio, right? The ratio between the spontaneous assets, so assets that will spontaneously or automatically or simultaneously increase with the increasing revenues, right? So they will increase together. So this is the ratio, right? And then if we multiply this one by the change in sales that we plan, right now you can imagine this is the uh, we estimate, right, the ratio, right? How much percent of spontaneous assets uh, as part of in comparison to revenues, and then we multiply it by we multiply the ratio by the change in sales. So this essentially measures the amount of assets, like the increase in assets required to support the increase in sales. You can imagine, right? This is the ratio. So this is the amount of spontaneous assets required to support the increasing revenues, right? Okay, so see the big framework again. So we have increasing revenues, and then we have to increase assets, right? Represented by this equation. See here. Okay. Now the question is, uh, how can the increase in assets be supported by our internal financing? So the first one, right, based on our story above, right? The, so we are asking now. We have spontaneous liabilities, right, as a ratio to revenue. So again, this is the ratio of spontaneous liabilities. So those liabilities that we consider spontaneous or simultaneous, so they will spontaneously increase with revenues, right? With the increase in revenues. So if we multiply this ratio by the change in sales, right, again, this measures the amount of liabilities, right? The amount of liabilities that will spontaneously increase because of the increase in sales or revenues. So I use sales and revenues interchangeably, but to avoid confusion, I'll just use R, right, revenues, okay? Because we're using R here. Okay, so again, the first internal financing that we expect to be able to support the increase in assets is the spontaneous liabilities increase, right? As a consequence of the increasing revenue projections. And the second item, right? The second item would be equity. You see here again, right? Equity. So how much uh, natural increase in equity that could be acquired, right? And again, the natural increase in equity is our retained earnings, right? So now imagine we have net income, right now as a ratio to revenues. I hope you still remember what ratio it is. Yes, it's profit margin, right? So profit margin. So we have our profit margin. If we multiply the current profit margin by the next period's revenues, so you can imagine, right? So we have profit margin multiplied by uh, the next period's revenues, then essentially we will get an estimate of the next period's net income. Agree, right? So we have profit margin, we multiply the profit margin by the next year's revenue. So we will get the amount of, or the projected net income for the next period, right? However, we have to realize that not all amount of the net income could be saved or could be retained, because a certain proportion of the net income will be distributed as dividends, or maybe the company will use it to repurchase stock, right, or for other corporate actions. So the amount that we could retain is only the one that is called the retention ratio. That's why we have to multiply this finding with the retention ratio, or 1 minus payout ratio, right? One more time, right? So the profit margin multiplied by the next year's revenues. So we will get the projected net income for the next period. And if we multiply it by the retention ratio, or 1 minus payout ratio, then we will get the amount that we could retain, right? Or we could save out of the projected net income. Okay, so let's summarize again. So because of the increasing revenue projections that we want or we target, then we will need an increase in assets, right? Especially at least the spontaneous assets. It has to increase, right, with the increasing revenues. And how to support or how to finance the increase in assets? The first internal hope or internal financing is the increase in spontaneous liabilities. So we hope that some items of the liabilities will simultaneously increase with the increasing revenues and assets to support, again, the increasing assets. And also the second one, the natural increase in equity that stems from the addition to our retained earnings. So we start from here, the profit margin multiplied by next period's revenues. So we will get the estimate of next period's net income, and then we multiply it by the retention ratio to determine or to estimate how much money that could be retained out of the projected net income. Okay, so again, if the increasing assets cannot be supported by, or cannot be sufficiently supported by, the increasing in spontaneous liabilities there and the increase in retained earnings, then we will have a positive EFN, right? And EFN again is the external funds needed, right? External funds needed. So if, again, one more time, if the increasing assets cannot be sufficiently financed or supported by the increase in spontaneous liabilities and the increase in retained earnings, then we will have the positive external financing needed, or external funds needed. See the example now, make it clearer. So I have prepared an Excel with a hypothetical company. This is a Grace and Tooth company. Right, so don't look at this one for now. We start from the 2020. Okay, so we have a hypothetical company, right, with revenues of 1 million, or if this is in thousand, then we can say 1 billion, right? Okay, so 1 billion, right, the revenues, and then we have the cost of goods sold, the cost of sales, 620,000. So many companies, or let me rephrase my statement. Every company will choose its own approach or method to estimating the like cost of goods sold, right? Many companies will choose the percentage of sales method. I think that is the most straightforward and the easiest one, because you just make like an assumption, like the cost of goods sold is like 60% of revenues, 60% of revenues, right? So if the revenues are 1 billion, then the cost of goods sold will be 100 million or something like that, right? But for the sake of uh, this example, to make it a bit different and also more complicated, more complex, so I choose to use this one. Okay. Again, this is an arbitrary, so I just make a hypothetical example, right? So let's say this company is using this regression equation instead of the percentage of sales method, right, for the cost of goods sold. So the regression coefficient based on the historical data shows that the constant is 120,000, the beta is 0.5, right, times the revenue. So here's how we get it, right? 120,000 plus 0.5 times 1 billion. So we get 620 million for the cost of goods sold in 2020. Of course, gross profit, right? We deduct sales, we deduct cost of goods sales from sales. And then now this one, similarly, operating expenses. Again, this is like a simplified example, right? Actually, in general accounting, you have a long list of operating expenses, including like the depreciation and amortization expenses. Right? Could be both. You have there general expenses. You have maybe administrative expense. You have the staff salary, also executive compensation expense. You have advertising expense. You have, of course, depreciation. You have amortization and many other things. So to save the space, I just combine everything into one. So operating expenses, including depreciation expense. This is complicated one, right? If you study the intermediate or advanced accounting, the depreciation expense is one of the most complicated things, right? Because you know that in the real company, you have a depreciation expense on existing assets, and you have depreciation expense on new assets, and then you have the depreciation expense on uh, spontaneous capital expenditures that might happen every year. So you have a lot of complication there, right? Because the what's that the number of assets is quite extensive, right? And then you have like new assets coming every several years or every uh, several months even, and also you have the uh, spontaneous, right? The spontaneous capital expenditures. So you have at least three types of depreciation expense. But for this one, because we are not focusing on the accounting treatment or accounting procedure, so we'll just combine everything into one for the operating expenses. And again, I don't use the percentage of sales method, but I'm using a regression coefficient. Right? So minus 100,000 plus 0.3174 times sales. Right? You can see here. So we got the number from there, right? And then the operating profit, right? So assuming we have no item for the other income or loss, so the operating profit is then automatically the EBIT as well. EBIT, right? The EBIT, earnings before interest and taxes. Okay, so next one, right, earnings before interest and taxes. We have the interest expense, right? Interest expense. So 57,600. Where is it from? So there are two items here. The first one is long-term debt. So the interest rate. So the interest rate is 10%. So let's see long-term debt, right? In on our balance sheet. Where is it? Here, this one. So long-term debt is 480,000, and the interest rate is 10%, right? So you get 48,000. And then we have another one, 8%. So let's see our short-term debt. So this one is free. This one is free. Now this one is not free, right? Notes payable. So you issued notes payable in the past. It's at 120,000. Uh, sorry, the interest rate is 8%. So 8% of this one. 8% of 8% of 120,000 is 9,600, right? Okay, so you add them together, 57,600 with the interest expense, right? And so we have EBIT, have interest expense, then we get the EBT, right? Earnings before tax. So in the United States, you might have taxes, right? Earnings before taxes. In other countries, you may only have one, right? One tax. So let's suppose the tax is 40%, right? 40% of 125,000 is 50,000, right? So 40% of 125, so 50,000. And then the net income, EBT minus tax, you get the net income, right? 75,000. And then this company decided to pay out 40% of the net income as dividends. Right? So 40% of the net income is paid out as dividends. And of course, the remaining amount would be the retained earnings, right? The corporate savings, right? Retained earnings. So this is our what's that? The basic information, right? Basic information that we have, and we'll see the uh, existing information on our balance sheet. This one, you see, cash. Okay, now this one we are using the percentage of sales method, right? So for example, this is 10% of sales. So this is what this would be, 10% of 10% of 1 billion is 100 million, right? Yeah, this is in thousand once again, right? So 10% of 1 billion is 100 million. And then 4.17%, 4.17% of 1 billion is 41,000. Then what else? Accounts receivable. Accounts receivable is 25%. 25% of revenues, right? Percentage of sales method again. 250 million. And the inventories at 35%. So these are uh, the item that will spontaneously no, increase as part of sales, right? Part of the revenues. Okay, so we have current assets, right? The sum of this, right? Okay, and then fixed assets is 920,000. This is given, I mean, from the from our data. Net fixed assets mean that these are fixed assets that have deducted depreciation, accumulated depreciation for those fixed assets. Right? So our total assets is 1.6 billion, right? 1.6 billion. What about the financing side? We have accounts payable, right? Again, we are using the percentage of sales method here. 5% of 1 billion, right? 5% of 1 billion is 50 million, right? So again, this is in thousand, right? 2% accruals, or you accrue expenses, right? The salaries for your employees and something like that. So 2% of 1 billion is 20,000, right? So notes payable. So maybe I have to repeat a little bit, right? So you see all these items here in this example are considered spontaneous. You see, right? They're increasing together with the increasing revenues. However, in real life, you have to check one by one. Right? For example, the second one here, marketable securities. Right? In some companies, marketable securities are not spontaneous because maybe the company is making a deliberate decision, right? Really a conscious decision on the marketable securities investment, right? But in this example, I put marketable securities as a spontaneous asset. But again, this doesn't always, no, it's not always true in every case. I have to be careful with that. So accounts receivable, inventory, so you still have to check one by one. Now we see this one, like accounts payable. Most likely this is spontaneous, right? Because now we keep buying materials from suppliers, right? Keep getting materials into our warehouses. Also, accruals are naturally uh, spontaneous, right? Because if we have business, then most likely uh, these are spontaneous. But this one not payable. This could no. Most likely this is not spontaneous, right? Because you can imagine not payable. So you issued not payable in the past. This is certainly a deliberate decision, right? A business and conscious decision. So to differentiate the spontaneous activities and non-spontaneous activities, it's very quite easy to imagine. Let's say one day your supplier comes to your door very early in the morning. Okay, so the supplier knocks your door, and you just walk up and you open the door unhappily because it was too early, and the supplier just asked you a simple and quick question. Right? He or she said, "I just put the no new batches of materials into your warehouse. So do you want to pay right now, or you want to, if you don't want to pay right now, I give you two choices. The first choice is you have 2 weeks to pay me. I will give you a discount, right? That's usually the case, right? If you pay me within 2 weeks, I will give you maybe 1 or 2% discount. However, if you don't want to pay within 2 weeks, I will give you like maximum 2 months to pay, right? So very easy to imagine, right? If you just walk up and you got that kind of question, then you would answer whatever, right? Roughly. I mean, yeah, I could pay within 2 weeks. I could pay within 2 months. It's not a big deal. Why isn't it a big deal? Because the accounts payable usually doesn't carry any interest charge, right? Okay, so that makes it easier for you to decide, right? Because you're thinking, if I paid within 2 weeks, I will get a discount maybe of 2%. But if I choose not to do it, then I have 2 months, right, to repay to my supplier. So this is a difficult decision because the accounts payable once again usually doesn't carry any interest charge. However, now notes payable, can you imagine? Can you ever do this? You just walk up and immediately wrote notes payable. So can you issue a notes payable just uh, randomly, right? Just without any clear conscience or like thorough consideration? That's hard to imagine, right? Hard to imagine that. I think that can never happen. So notes payable is most likely, or is certainly, non-spontaneous. Okay, so this is determined by the real, like 120 million. Right? So our current liabilities, right? Current liabilities, we sum this. The long-term debt is obviously non-spontaneous, right? This is not spontaneous, okay? So it's given or based on the data. Then common stock is of course not spontaneous. And retained earnings, this is our existing retained earnings, 671 million. Okay, now we sum all of them here. Okay, we get 1.661. Of course, this will correspond with the amount of total assets. Okay, so now we go back to now the projection, right? See the story here. In 2021, sales will increase by 20%. Okay, and dividend will remain at 40%. Okay, so let's make a projection now. So 1 billion will become 1.2 billion, right? Again, this is in thousand, right? So the revenues are projected to increase by 20%, right? So it becomes 1.2 billion. Cost of goods sold, again, we are using this formula, right? 120,000 plus 0.5 times sales. So we get 720 million. Then the gross profit, again, is the gap, right? The difference between sales and the cost of goods sold. Then operating expenses, again, we are using this formula, this regression equation, minus 120,000 plus 0.3174 times sales. So we get this. Okay, we get the EBIT, right? EBIT. And then now assuming that the interest expense doesn't change, right? So you are still paying 57,600. We get the EBT, EBIT minus interest expense. We get EBT minus tax of 40%. Right? 40% of 161 is 64,000. Then we get the net income. And then see from the information, dividend will remain at 40%, right? So 40% of 96,912 is 38,761. So 40% will be distributed as dividend. So the remaining 60% would be added to our retained earnings. Okay, so now, of course, we have the mechanical in Excel, but we can start comparing to the, formula. So we calculate the EFN, right? Okay, now we make the balance sheet, right? So sales of percent of sales method, right? Now 10% off. Be careful, right? 10% off the new revenues, right? 1.2 billion. So 10% of 1.2 billion is 120 million. Okay, and then 4.17% as it was before. So we actually maintain the ratios, right? The percentage of sales ratios. So 4.17% of 1 billion. Sorry, 1.2 billion right now, the new one. Okay, so 50,000, right? And then 25% of 1.2 billion is 300,000. 35% of 1.2 billion is 420 million, right? So now we have the new total current assets of 890 million. And the fixed assets, so we assume that the amount of net fixed assets, the amount is the same as the previous year or the current year. Again, in real life, you have to determine this one by yourself, right? You might have like new fixed assets, and then depreciation, the accumulated depreciation keeps changing, right, for all fixed assets. But because we are not focusing on that, so we just, for the sake of this example, we just assume that it doesn't change, right? The amount of net fixed assets remains at 920,000. So total assets now, here, these two, we add these two, and we get 1.8 1,810 million. Okay, now accounts payable, now 5%, again, percent of sales method, 5% of the new sales at 1.2 billion. So 60 million, right? 2% of 1.2 billion is 24 million, right? And notes payable, again, this is not spontaneous. So the previous year showed notes payable of 120,000. And again, for the sake of example, we maintain the amount, but again, in real life, this might decrease, this might increase, right? Maybe you have new bonds payable. Maybe you just issued a new series of bond last year or something like that. But again, for the sake of example, we maintain the amount. Right? So now current liabilities, the current liabilities are now 204 million. Long-term debt also doesn't change, right? 480 million. Again, in real life, of course, this will change, right? You might have repaid some amount of the, I would say, the principal of the debt, right? Or maybe you just added new debt or something like that. So yeah, everything could change or will change, right, in real life. But for this example, because we are focusing on EFN, we assume that the amount remains at 480 million. And also common stock, the same thing here. If you notice, last year was also 320. So we assume that they don't add any common stock at all. Now, retained earnings. Now this will change, right? Okay, so the previous retained earnings were 671 million, right? And remember, this year, right, based on this year income statement or the subsequent years projection, will have like additional 58 million to our retained earnings. So we have the previous one, 671 million. We have the addition, right, based on the projection for next period, for next year, right, 58 million. So we add them together, okay, we get 729 million something. Okay, so now, okay, so I will erase this one, right? Okay. So if you calculate using Excel, calculate by Excel, so you know that the amount of, we can check that. So the amount of your assets is 1.8 billion, right? And what is your amount of liabilities? So add this current liabilities plus long-term debt plus common stock plus retained earnings. Okay, agree, right? So current liabilities plus long-term debt plus common stock plus retained earnings. And the amount is, you see, they don't match, right? The 1.8 billion here is 1.7 billion. It means that the financing is not enough. Then the difference would be, again, the difference would be the EFN, right? The EFN. So calculate the EFN now. EFN would be the difference between this one and sum of this, right? Right, again, one more time, the difference between 1.8 billion and this is our available financing right now, and we know that it's not sufficient, right? Okay, so the difference is 76 million, right? 76 million, right? So let's recalculate now the amount of liabilities and equity. So current liabilities, long-term debt, common stock, retained earnings, right? The accumulated retained earnings, and the EFN, and we should get 1.8 billion. Okay, so it perfectly matches the amount of new the amount of assets in the in the subsequent year. Okay, so our EFN, our external financing needed, is 76 million. Okay, now we'll try to use the mechanical method to find the EFN, right, to compare their results. Okay, so try to apply this method, right, on our example. So check EFN should equal. So let's calculate our spontaneous assets. You see here we have 4 items of spontaneous assets. Or maybe you just find the ratio right away. So again, this is the spontaneous assets divided by current revenues, 1 billion, right? Oops. So 74.17%, right? This the ratio of the spontaneous assets to current revenues. So if we multiply this by the change in revenues, how much is our target again? From 1 billion to 1.2 billion, right? 20% increase. So let's find this one. If we multiply this by the increase in revenues, so we find out that we'll need an additional 148 million of spontaneous assets. Right? Okay, so what about the the first internal financing that we hope to help support the increase in assets because of the increasing revenues? So let's calculate now. How much is our spontaneous liabilities? So in our example, we only have two liabilities that we consider spontaneous, right? Okay, so our spontaneous liabilities divided by current revenues. Okay, so 7%, right? 7%. So this 7% is then multiplied by the change in revenues that we plan. Okay, so 14,000, so 14 million, right? So we can expect an increase in spontaneous liabilities by 14 million, right? What about the natural, no, natural addition or increase in our equity, which is the retained earnings? Okay, so firstly, we'll estimate the profit margin, right? The current profit margin. Current profit margin, 75 million divided by 1 billion, right? This is the current profit margin. Okay. Okay, so the profit margin is 7.5%, right? So if we multiply the profit margin by our projected revenues, right, for the next period, and we'll get about 90 million. However, remember that not all of the net income could be retained or could be saved. So how much could be saved? Only the retention ratio part, right? So certain proportion again will be distributed as dividends or stock repurchases or something like that. So we have to multiply this amount by the retention ratio. Retention ratio is 1 minus the payout ratio, and our payout ratio, according to the story, is 40%, right? So 60% would be retained or would be saved. Okay, so we find out 54 million, right? So do the math again. So I forgot to write it here to make sure that we could. It's 200 million, right? So I will write 200,000 here. Minus what is it again? 7.5%. Oh no, 7%. And the increase in revenues, right? Minus. So 1.5. Profit margin times the next revenues at 1.2. So billion. So I will use the complete form then. Right, times 1 minus dividend payout ratio. So we can retain 60%, right? So this would be, let's find out. So the required increase in assets is 148 million, and we got support from the increase in spontaneous liabilities by 14 million and increase in retained earnings by 54 million. So we have 80 million. So if you compare this mechanical method with the manual one or the the real one, then you see a little difference, a little gap. So the real one is 76 million, and you know why? The difference stems from this one, right? The third part, because we are using the existing profit margin instead of the new profit margin, or the net income in the next period divided by revenues in the next period. Because you can imagine that if you use this method, I mean, if you use the mechanical method, then it is assumed that we don't have, or we don't make any projection yet for the next year's net income, right? We only have the projection for revenues, right? So next year's projection for revenues, but we don't have the projection of net income for the subsequent period. So that makes a difference here, a little difference. So it should be should be 76 million, but based on the mechanical calculation, we got 80 million, right? 80 million. Okay. Okay, should be 76 million something. Okay. Again, the difference stems from this one, comes from the profit margin, because we are using the net income in the current period divided by revenues in the current period to define the profit margin. Okay, I hope that the discussion on the forecasting and external funds needed is beneficial to you, and this would be the backbone, or the first but most important step to conduct the valuation. Right. Thank you, and see you next time.